Good day to everybody, because I know we're in different time zones. The beginning of the 21st century was notable because instead of writing 19, we are now writing 20 in dating things. But there were events happening in the corporate world which were material. And those events included empirically establishing that we and to a greater extent, the limited liability company was using natural assets faster than nature was regenerating them, clearly not a sustainable matter. Also, by 1997, Senator Alan White and me and other people realized that the makeup of the market capitalization of some iconic companies was changing. And as we turned into the 21st century, only about 20% of the makeup of the market cap was reflected as additives in a balance sheet according to financial reporting standards. This led to the drafting of guidelines for the Global Reporting Initiative, and the very name of that institution indicates that it was an initiative to try to give guidance to corporations, essentially, and other organizations on how to report on these incorporeals, intangibles, sustainability, and now called ESG issues. It was IFAC, Gordon Lidstrom and Alan Ball, president and then chief executive, called for a meeting at the United Nations. I was chairman of the United Nations on Governance and Oversight and chairman of the GRI at the time. And we discussed that, in fact, directors were not discharging their duty of accountability, because if they were doing an annual report consisting just of the financial statements, according to IASB or FASB, they were obviously not discharging their duty of accountability because of the makeup of the market cap. And then when they started reporting in two silos, financial and then the impacts of how the company made its product and the impacts, the outputs, then the impacts when the product went into society and the impacts it had on the Brundtland's three critical dimensions for sustainable development: the economy, society, and the environment. I said at the time that this was divorced from reality, to report in two silos, because in fact these things are like a symphony. They work together in order to produce this symphony. And so the discussion started about connecting this information or integrating this information. And the debate I remember well, going back to about 2008, Sir Michael Peet of Peet Marwick fame, Jennifer Fries, Paul Druckmann, and others, we argued about whether it's connected reporting or integrated reporting to put together the financial and the so-called non-financial information. And the etymology of the word connection is link. The etymology of the word integration is a system. And I and others argued that what we were looking for was a system of corporate reporting, which would be a stepping stone to what we regarded as an end game, namely a global comprehensive corporate reporting system. This led to the GRI and A4S, the Prince Charles's Trust, getting together and launching the International Integrated Reporting Council at St. James's Palace, which I became the founding chairman. And we had drafted already in South Africa the framework for an integrated report, because I, as chairman of the so-called King Committee on Corporate Governance in South Africa, had by 2016, already 2009, recommended that we should do integrated reports in South Africa. The Johannesburg Stock Exchange agreed with that, and it became a listing requirement. That blueprint was used by the international body in order to draw the IR framework, which we all know so well, the International Integrated Reporting Framework. And so the start of integrating, connecting the financial and non-financial information was there. But we were still looking at sustainability from inside out, how you make your product and the impacts on the outcomes of that. Meanwhile, there were some seismic events, such as the collapse of Lehman Brothers, which showed there was an impact on the financial position of the company, its balance sheet, on its operating performance, its income statement, its cash flow, and its risk profile, its cost of capital. And it was these events that launched Sustainability Accountancy Standards Board, also approximately 10, 11 years ago. And they started looking at sustainability from the impacts of the Brundtland's 3 critical dimensions for sustainable development. I'll use their language: people, planet, and prosperity, on the limited liability company, and of course other organizations. So suddenly we saw that sustainability, like a coin, had 2 sides to it. And in 2019, I gave a talk in London, and fortunately, the executives of the myriad of framework providers and standard setters that had leapt into this ESG space were present. And I said it was a moral and social outrage that they saw themselves as competitors when they were, in fact, all had the same end, the same outcome they wanted, namely a global comprehensive corporate reporting system and some consistency in this reporting, rather than the clutter and confusion which was being created for preparers and for users. I'm told that this had some effect on the executives of the various entities, but it was really, I believe, the pandemic, COVID pandemic, where they were able to see the power of SDG 17, collaboration. Our scientists collaborated in 9 months to develop a vaccine rather than 9 years. And so the group of 5, which included the IRC and SASB, issued a statement of collaboration. Inevitably, collaboration led to talks of merger, and SASB and the IRC merged. And then further talks, further progress. The VRF was, I'm going to use a commercial term, sold. There was no price, sold to the IFRS. And the SASB standards were pushed into a new body being formed, the International Sustainability Standards Board, also under the oversight of the IFRS, but a sibling to the IASB. And the IR framework would remain in the IFRS. Well, there was a problem with that as we proceeded, because the IASB and the ISSB have power to evolve, to set standards. The IFRS is a monitoring and oversight board under IOSCO. and they don't have the power to create standards. Or so I speculate that I think the answer to the problem is for IFRS to pass ownership jointly to the IASB and the ISSB to form a working group um, in regard to the IR framework, which would be a baseline for the creation of the integration and connectivity of the financial and the non-financial. Meanwhile, the ISSB would go about its business of forming global baseline sustainability reporting disclosures, which the different jurisdictions in the world on a layered approach could add what was pertinent to them in their area. So I think the beginning of the end of clutter and confusion was the issue of the statement of collaboration. But we're now at the beginning of the end of all that, and we're at a whole new beginning. And we are, I think, through IFRS, about to create a very large stepping stone towards moving from a side of the river of corporate reporting, of clutter and confusion, to one of a global comprehensive corporate reporting system. And hence, in deciding the content and the theme of the 7th colloquium, we use the word connectivity. And it is so important that this is connected. And what intrigues me, and I think it'll intrigue all of us as the years progress, that the one common cause of the EU with its ERSR and the SEC in Europe, China with some of its statements, that the one common cause going through all these international bodies is that there needs to be this connectivity between the financial and the non-financial. Otherwise, you will not get the true enterprise value of a corporation, and hence the theme of connectivity.